All right. So I was telling you, all these startup masterclass sessions had been more offline, but since this outbreak appeared, and we thought to engage the startup community online, through our efforts. So we came out with the weekly webinar idea, and thankfully we have Kunal supporting us for this initiative. So welcome, Kunal, on today's startup masterclass. For the benefit of everybody, I'll just repeat that I'm Vineet Khurana. I run Chandigarh Angels Network. We are a small team and a bunch of angel investors who are trying to invest in startups from Chandigarh and beyond. Currently, we hold 17 startups in our portfolio, and you must be aware of a few. For example, from the consumer end, you might have heard of Biryani by Kilo and a few more in our portfolio. For more details on CAN, you can go to chandigarhangelsnetwork.com and find more about us. And more on that later. But I'll do a brief introduction of Kunal. So Kunal is a serial entrepreneur, and many of you are aware of him. He's also one of the founding members of Chandigarh Angels Network, and he is the co-founder of uTrade Solutions, along with some other startups that he chose to start off lately. And he's also active in the startup circle of Chandigarh and beyond. So feel free to connect with him later after the session. And Kunal, would you like to add something to your introduction? Anything that I'm missing on?
No, it's okay. I think let's start with the questions. I think people may want to just get into the content, I hope. So
Sure. Guys, so today's session is more around startup funding. And, we did this survey. We asked people who attended our previous meetings about, which questions should we be asking the experts in our next session. And we came with many questions around startup funding. So we thought, to create a list of such questions recommended by you. So all the questions that I'm going to ask today, these are all crowdsourced. You have recommended what to ask, and I'm just going to read them out and ask Kunal, on his opinion and what does he think about all this. So to start with, Kunal, some of our participants wanted some clarity on different stages and types of startup funding. So what are the types of startup funding? What are the stages of startup funding? If you can elaborate that and throw some light on it, we'll be grateful.
Sure. So you can hear me okay, right?
Yes.
Can you hear me okay?
We can. Go ahead.
Yeah, okay. So basically let me, okay. So say you want to do a startup right now. Some of you are at idea stage, some of you have started doing the company setup, etc. And some of you are a bit advanced. So depending on when you start, there are different kinds of investors or funding you can look at. The earliest, and I'll try to explain this with the startup journey. The earliest stage of funding is the idea stage. So let's say you get an idea today that you want to do something interesting in light of COVID-19, the world would evolve differently. So you want to do a startup idea to solve some problem. When it's just an idea in your stage, you typically go for the first round of funding if you need money, which is from friends, family, and fools. It's called FFF, friends, families, and fools. Essentially, all it means is these are the people who know you, trust you, who want to help you, okay? And they just want to make sure you can do what you want, what you're trying to do. And they will give you the first few lakhs. The amount may vary from, let's say, dozen rupees to few lakhs rupees or more in few crores, depending on how well placed your friends, family network is. That's a typical family funding, the first round. Okay. Typically, what happens is, let's say, and I'm gonna take some examples. Let's say you took 10 lakh rupees from your uncle and your parents, and you started building something. You brought in one co-founder who's a friend of yours from somewhere, and you started developing some application or some software on laptop, set up a company. 10 may be able to run for about 6 months to 1 year, depending on how you are executing, how big your team is. And at some point, you will have a product or a service ready, which you will then take to the market and hopefully start making or generating flow. And then when you have some traction, that's when you move to the next round of funding, which is typically angel investors funding. Angel investors are typically professionals, entrepreneurs themselves, or men who have built some businesses or are running some businesses and have some spare cash flows and some money to that they choose to invest in startups. It's a very risky investment from angel investors' perspective because, as you know, you might 90% plus startups do not survive the first 3 to 5 years. So frankly, it's not that every angel investor gets rich necessarily by investing in startups. But yes, that's a hope that in time when they invest and as they invest, some startups will do better than others, and some startups will end up giving them good returns, but many others would fail as well. So this stage of funding is called angel funding, which you typically get after some traction. It means that you've set up a company, you have a team of people, maybe 1, 2, 3, 4, 5, 10, X number of people, you have some product or service, you have some client validation, and you have some cash flow going for you. Okay, some business, some money is coming into the business. This is when, typically speaking, angel investors would come in. The typical amount they may invest will vary from based on your needs and based on what they are willing to contribute, but the amount typically varies from 10, 20 lakh rupees to up to 2, 3, 4 crores. Okay. And this is the first semi-professional round of funding where these guys are, while not full-time investors, but they are just investing on startups on the side. Okay. So this is the angel investment round, second round of funding, typically that people take. Third round of funding after this comes when you have grown your business to, let's say, you've run it for 2, 3, 4, 5 years. You have some revenue of, let's say, running in few crores. You have a team of a few dozen people. At this stage, you go to the professional investors who just do investment for a living. These are called venture capital firms. And this first round of funding, which comes from them, is called Series A funding. Series A means it's the first big venture capital round that you bring in. The amount varies from, let's say, anywhere between $1 million to $10 million or so. $1 million, roughly translated today, is about 7 crore rupees. So it's about 5 to 50 crores is what the norm is, which you will get as an angel investment round. With this 5 to 50 crores, you with this five with sorry, guys, can I ask everyone to be on mute, please? Kindly be on mute, everyone, and please don't turn on your video camera. It just reduces the bandwidth usage. Okay,
Just a moment.
guys, Vineet, can we put them on mute or no?
We can. We are putting them. Those who are just joining in,
Okay,
we are putting them on mute.
okay, fine,
Yeah.
fine. Okay, fine. Do what you have to. Okay. So, guys, so I was continuing. So, the VC round is 5 to 50 crore rupees. These venture capital firms actually get involved in your business as well. So, your friends, family, or angel investors typically do not get involved. They typically do not take a board seat in your company. But the venture capital firms, they typically do take board seats and they do get involved in the sense that at least once a month, if not more frequently, they'll be spending time with you. They'll be looking at your monthly performances. They'll help you set the annual targets, etc., etc. So that's the real money. That's when game gets real. Now, at this stage, just so you understand, this is when you start, as somebody else starts getting involved, this is when you start losing control too. Now, until the friends family round or until the angel investment round, you can do whatever you want with your business. You can pivot, you can evolve, you can perform well or badly, etc. Not many people are going to look too closely. But the moment the venture capital firms get involved, they look in very seriously because that's their job. Their job is to manage a portfolio of companies full time. That's what they do for a living, and their incentives are tied up with the performance of your company. So essentially, they are incentivized to work closely with you. Remember, you may have started your business with some vision, some idea. You may have wanted to solve some problem. You may be passionate about a sector, but these guys are typically not very, very, aligned necessarily with your cause. but they are just more aligned with the fact that you have a business that can grow. So frankly, they will possibly at times push you into making decisions for the business which are not great for the business or the cause it was set up for, but still okay for short term cash flows and profits and revenues, etc. So just remember this. This is how the Series A venture capital round one works. Once after that, you've spent 1 to 3 years, these venture capital firms will help you raise the second round from bigger investors. They'll partially fund the Series B round, which is the second round of funding. The amount varies between 30, 40 crores to 100 crores or so. They will help bring the next round of investors for your business. They will partially fund it themselves, and they will stay involved for this round, most likely. Um, and again, at this stage, someone else starts getting involved. Somebody else starts also getting heavily involved in your business, in your board, in your decision making. So remember, now you're starting to lose control. Okay, this also happens. So it's not just that you're getting free money. You are getting money, but it's coming with a lot of strings attached to it. That's a Series B investment round. And this continues for Series B. After B, you go to C, D, E. And eventually, either your company, if it keeps growing and doing well, you will get listed in a public market in a stock exchange, or some bigger other company will buy you out. Okay? Depending on which business you are in, what are the times, how complementary you are to someone else, etc. So these kind of things happen. So this is typical round. Recapping for everyone who joined a bit later. First round is friends, family round. Second round is angel investors. Third is Series A from venture capital firms, then Series B from venture capital firms, then Series C, D, E. Just so you know, the percentage of people who think about starting a business, who have an idea, some of you might be at startup idea stage, versus the people who actually set up the company and get started. Probably if there are 100 people with an idea, only 5 or 10 will actually go and do it, because many will get scared, many will not have the full idea, execution, conviction, guts, or whatever is needed to run a business. Okay. Out of every round of funding, assume in after friends family round, let's say 100 people got friends family round funding. Not everyone makes it to the angel round. Only maybe again 10-20% will get to the angel round of investment. 80% would not. Out of the people who get angel funded, 10-20% people may make it. 10%, 10-20% companies may make it to the VC's Series A round. Out of every company that raises VC Series A round, doesn't mean all of them get it to Series B. Many of them, 70% of them also fail and shut down in the next 3 years. Only 20-30% will go to Series B, then 20-30% will continue to Series C. Point I'm trying to make is the following, that it gets more and more and more competitive once you keep raising funds and growing your business. It's just like anything else in life. And also that raising funds is not a sign of success. You raise funds, it's good. Somebody backs you, somebody believes in you, gives you some cash to have some business runway for a few months or few years, but it doesn't mean that you're successful. We actually somehow we somehow interpret fundraising as a sign of success. It's not a sign of success. It just means that yes, you can run for a bit longer, but you can still fail. Okay, and many companies do. Take any example. Snapdeal raised tons of money for a number of years. Eventually, it did not necessarily do that well. After a point, many other companies have shut down. Look at recent ones, WeWork, likely to shut down, many others who've raised tons of money, and still fundraising is not the only thing. And also, when you raise funds, sometimes from investors, they end up moving your business plan around in a way that it doesn't align with you anymore. So, if you can run a business by bootstrapping and not raising funds, that's the most ideal scenario. I'm not here telling everyone that you should have an investor or you should have investors at all. Your business may need it, consider it. If it doesn't need it, it's the best thing. If you can avoid raising funds, it's the easiest thing. You will be more in control of your destiny as long as you can manage your business by bootstrapping, which means that whatever money you get from the clients or any advertising or whatever your business model is, however you generate some cash, use it to run your business and use it to reinvest and grow your business. That's the most ideal way. This is how by the way, all the startups were done decades ago. Any traditional industrialist would invest their own money, start the business, grow it, They will not take too much money. They may take a little bit of bank's loan or debt, but they will not take too much external capital from equity investors. Okay, so these are different kinds of funding rounds that are available, typically speaking, in Indian context as well as in global context. And I hope I've covered broadly at a very high level how this works. Vineet, happy to take the subsequent question.
Sure, sure. Thank you very much for this elaborate coverage. Now, one of the questions was, what is the quickest way to raise funding for your startup?
So, unfortunately, there is no quick way. The quickest way is uh, I'm trying to think what's a quick way. So, just to explain to you, the quickest way is to be in a friends and family where they have crores of money and they can give it to you. So, sort of like be in the Ambani family or Adani family, which is, I guess, not possible for many. So, you get money from them and that's it, you're sorted. Second quickest way, take it as a joke and take it in a context. Okay, it's coming to mind, so I think it's worth sharing. They say if your father is a poor man, that's your destiny. But if your father-in-law is a poor man, that's your stupidity. Um, so marry rich, marry up. Just again, don't do it. It's not advised to take any money from in-laws ever. But that was just a joke. Take it that way. So there is no quick way. Frankly, there is no quick way. The angel investment round after so friends family round depends if you have friends or family who can help you. If they have money, you can get it quickly from them in a few days, hopefully, as long as the trust level is good and they want to support you. If you go to when you go to the angel investment round, that is the easiest round in grand scheme of things, so it's hard in itself, but it's the easiest in relative terms. That itself will take at least 3 months to close, in the sense that from the day you pitch or approach an angel investor to the time you get money in your account, it's a 3 months process at least. Can run up to 6 months. This is something we're telling from experience of Chandigarh Angels Network and some of the investments I've been doing. Because what happens is you pitch to many angel investors, some come back, some show interest, some don't, some go into details. Then they will ask for term sheets. Then there is a legal contract negotiation. Then there are things like valuation negotiations. Then they do due diligence of what you have done so far in terms of your company, whether you are complying with all the Indian regulatory laws, whether you have the business you say you have, etc. So these things take time. It takes at least 3 months. There is no shortcut. Frankly, there's no quick way of raising money anywhere. All the shortcuts are really the funny ones, like the jokes I'm telling you, and I can tell you 10 more jokes, but this is not the time for that. I think it takes time. It just takes time. Okay, Vineet, please carry on.
Yep, yep. Now, how should an entrepreneur generate and manage the cash flows? Because cash flows was one of the topics that we included in the discussion. Also was suggested by a few people. So just wanted to bring this up.
Mm.
What's the way to generate and manage the cash flows?
So basically, what's the meaning of a business? Business is something which can generate cash flows, which can generate products that you can sell. Okay, product or services. So as a business, you produce something and you sell something, right? That's how it works. Now there is a cost of production. This is your cost, and there is a revenue you make by selling it. The way to generate cash flows, there are 2 3 ways. One is the best and the most ideal way: build a business in which you can get client advances or client pays you money upfront. An example, an airline business. In an airline business, what happens is that somebody wants to travel a month later. Let's say I want to travel next month. Obviously, assume it's not 2020, assume it was 2019 or 2018. If I had to travel a month later, I'll pay today to the airline to book my ticket, right? So this is a client advance. If you go to a supermarket will charge you immediately on the spot for the product you buy. Okay, you go to Big Bazaar or you go to any Reliance Fresh store, they charge you immediately. But they pay their suppliers, their vendors, the product companies, the FMCG companies, 3 months later or 2 months later. So the best way to generate cash is by bringing cash in advance from clients. So clients do not tell you that give me this and then I will pay. It should be that client pays you upfront, half the money, full money as far as possible, or you are able to sell a lot at the same time. This is the best way to generate money, by doing more business, essentially, whatever business you are in, and then keeping your cost low. So what is cash flow? Cash flow just means one thing. How much are you earning a month and minus how much are you spending? If you are earning more than what you're spending, means you're profitable, your cash flow is positive. Let's say you are earning 100 and you're spending 80, means your cash flow is positive 20, your business would continue. If, on the other hand, you're spending 100 and you're earning 80 every month, you know, you will soon run out of cash. Your cash flow is negative. It's minus 20, means you're burning more money than you're making. So you need to find a way to fund it. Funding could come from equity investors like angel investment funding that we talked about a little while ago. It could come from some banks in form of a loan. Banks also give loan to businesses. There are startup loan categories where there are preferential rates and non-collateral based loans available. So there are things like that you can look at. So this is broadly how you have
I'm
to
just
generate
keeping
and
it
manage the cash
here.
flow. Let me tell you one very simple thing, which is okay. Guys, please go on mute. There's one important thing I want to tell you, which no business school will teach you. Let me ask you a question. What's the number one job of the CEO of a company? Whether it's a big professional company, it's a listed company, it's a startup, it's anything. What's the number one job? Just try to think in your head. Do not answer. The number one job is to make sure that you have cash in the bank, meaning that you have money in the account to pay. The day you run out of money for whatever reason, that you did not generate enough business from your cash flows from the business, or you did not raise money timely, the day after, people walk out, you are unable to pay your office bills, and you shut down. Okay, so managing your cash flows is one very important thing, especially in the life of a startup, because early days, your cash flows are not very confirmed and guaranteed. You need to work hard to make sure the cash flows keep coming in. So it's a very important part. But essentially, cash flow just means, what is cash flow? What are you spending every month versus what you are earning? Okay. Just like your pocket monies you must have been doing as kids. Parents give you some pocket money. You spend on certain things you want, and you have to budget for others. And some things you don't do in a month, you do next month, right? To manage and live within your means. So this is how the cash flow of a company works as well.
Got it. Thank you. Now, what are the legal processes involved in startup funding?
So basically, how this works is uh, legal process is the following. When an investor comes in, you need to decide with the investor how much equity will they take for how much money. So the round I explained to you, friends, family round. After that, let's say angel round, Series A, VC round, Series B, VC round, etc. VC stands for venture capital firm. All these, in every round, you would typically dilute anywhere between 10 to 20% of your company on average. Meaning, if let's say you raise say 50 lakhs from an angel investors like Chandigarh Angels Network, say you raise 50 lakhs, the likelihood is that your company's valuation is, let's say I'm making a number up, is 5 crores. For a 5 crore valuation, you get 50 lakhs, means now the 10% of your company belongs to Chandigarh Angels Network's investors and 90% belongs to you. Or it could be that you've raised 1 crore at 5 crore valuation, which means that 20% of your company now belongs to the investors and 80% belongs to you. Subsequently, let's say you take this forward 3 years later, you raise 10 crores at 50 crores valuation. Remember, in the first round, you had given 20% equity to Chandigarh Angels Network, right? Now, in the next round, when you raise 10 crores at 50 crores valuation from a Series A VC round, then you will again give 20%, because 10 crore of 50 crores is a 20% number. 20% shares will again go to venture capital firm. Now, this is how the dilution of the company works, means that how many shares are you giving up? Okay. All these things, what are the rules of engagement? How is it that I will give you the money? How will you perform? What can you do or cannot do? How will you return the money? How will you run the company? What are the legal rules presiding that, etc., come in something called a term sheet. Term sheet is something which an investor signs along with the company in which they are investing. So you as a company will sign a term sheet with the investor. A term sheet is a typically 2-3 page document with some standard terms, and you can Google this standard term sheet for Series A funding or standard term sheet for angel investment funding. You'll get a lot of stuff online. You can look at those kind of terms. They will just say, I'm giving you this much money. in these phases, and this is how you're expected to work. These are the rights you have, these are the rights I have. That's the first legal document called a term sheet. Then the second document comes, which is typically called a shareholder agreement, which is that a detailed document of this. So term sheet was a high level summary of the key terms. Shareholder agreement governs the rights of all the shareholders, including the investor, including you, including your co-founders, including your employees, including your previous investors, as well as the process in which with which you can raise future money. So that's a detailed document which may be 10, 20, 30 pages, depending on who drafts it. That's called a shareholder agreement. These are broadly the two legal things you have to do. But then along with this, depending on the terms of your agreement, you will need to report this to the Indian authorities. So, there may be some income tax obligations you have to comply with, because any premium you charge on the share price value, you have to pay tax on that. You have to report some of these things. If your investors are overseas, investing from US account or UK or Hong Kong accounts or something like that, then you have to go through an RBI, Reserve Bank of India's rules around FEMA, which is Foreign Exchange Management Act, where you need to report this to RBI. Typically, your bank will help you do that. Then there are some local compliances in which you may have to report certain things to ROC, Registrar of Companies, and MCA, Ministry of Corporate Affairs. So there are some reporting guidelines, but this is typically helped and managed by your accountant or the accounting firm or any auditor firm that you may have hired or you may be working with. Otherwise, people like Chandigarh Angels Network, groups like ours also help you in guiding how to get this done. And there are people who do this for a living. So there are some legal processes essentially in which you will need to learn and get involved in. But uh, these are mere execution steps which can be done, and there are tons of people, CAs around, who can help you get these done. So essentially, the main things you will need to very carefully learn and follow is the term sheet and the shareholder agreement. Everything else is just broadly compliances.
Sure, Kunal. At Chandigarh Angels Network, we are touching almost 50 pitch sessions that we did. Now, pitch sessions are essentially for the benefit of our listeners. Pitch sessions are where the selected startups are brought to present to our investors. Kunal, so in your experience, what has been the most impressive pitching style that you would have witnessed from founders so far?
So, um, the best thing I think we like to see in the pitching startups, the best thing is that I think number one, they should be themselves. They should be honest. They should be, slightly obviously marketing themselves, etc. But should be really not faking too much. I think faking too much or trying to say that this is a multi-billion trillion dollar industry. Reality is angel investors are also running some businesses and or are involved in some businesses. They're not stupid that you can just fake anything through. So it's not, so to say, with all due respect, it's not your viva in a college or something, right? Where maybe the professor knows less than you, or maybe you can Google your way out of it. So be real. Integrity is very important. Number one, be honest, be real. One. Second, if you are really motivated and passionate about your business, I think anything coming from the heart of an entrepreneur rather than a prepared pitch, that goes a long way, because we see that how driven, passionate you are, because eventually any investor is typically backing not an idea, not a company, not a sector. They are backing you. They are backing the entrepreneur. So the belief in entrepreneur is built if the entrepreneur is really passionate and is coming across with a good depth of knowledge and knows it well and wants to do it very well. So that's a good motivation how you should do a startup in the first place, that you're really passionate about it. And then this reflects, hopefully, and the hard work you do as a startup entrepreneur for a number of months to years, it reflects in your pitches as well. So let it come from the heart, I imagine. Do not script it. Do not do big scripts, etc. Do not memorize stuff too much. Okay, what you know is what you know. Third, I think one other thing is that presentations. Do not keep wordy presentations. Do not keep a lot of text and images in your presentations. Your presentation should be like the following: 5 to 10 slides, very simple story, talk about, and for the reference, if you want to look in, search for one very well known slide deck from Airbnb, where they raised $10 billion valuation round and $1 billion money. Very, very simple slide, just one line headline, one image, one bullet point. Many times people are putting a lot of text in the presentation while pitching. It doesn't help, because then investors do not know know whether they should listen to you or read the presentation, and they start reading. Typically, you lose your audience. Okay, think about, so pitching style, you can improve a lot. You can learn a lot about. Two things you should do: your pitch deck. Look at Airbnb's pitch deck. Google it. It comes on the top. Very good. And on Chandigarh Angels Network website also, we have some templates. Feel free to look at them. Second, follow, like, Steve Jobs gave the iPhone launch. He did not show any presentation. He talked the story. He talked the great story. And behind the scenes on the screen, there was just one image. This is how it should come. The thing should come from you. This is how you engage your audience better. So that's the third thing I would say. And lastly, be a little flexible and open. Sometimes entrepreneurs come with a hard mindset that, I know everything about my business and I will not change my view or opinion about anything. I mean, you need to be a little flexible, because sometimes angel investors are curious to know, and they ask some questions where, if you don't know, you just say you don't know. And if you know, well, answer it. But if some investors have a different opinion, listen to them. Listen to them in genuinely a collaborative way, in a way that you can say, sure, we can look at that later, or we're happy to discuss this offline or now, as you prefer, time permitting, etc. So I think these are the few things which make the presentation go very well. One, it should be coming from your heart. Second, don't fake too much. Third, keep the presentation very clean, very less textual. And fourth, be a little flexible as well when you're speaking. Listen to others' opinions. Sometimes there's great feedback for you, which you're getting for free. So that's the least you get in a presentation process. These are some things which make it work, I think.
Sure. Thank you very much. Now, typically, out of your experience, what all the founders can negotiate upon with the investors? Is it the valuation? Is it the percentage that they are diluting against whatever X amount of money? And what else? What are the things that they can negotiate upon?
Okay, so typically the number one thing is the valuation only. Valuation and dilution go hand in hand. If your valuation is 5 crores and investors are putting in 50 lakhs, so you can negotiate and say, put in 60 lakhs and then take 10%, means that your valuation goes to 6 crores or something. You can try and do that. Valuation is number one thing you can negotiate. But remember, there's a thumb rule: 100% of zero is a zero. Okay, means that do not be afraid of letting your investor make money. Once they put in the money, you and they are in the same boat. You both want your company to do well. Okay, so it's okay if they also get good returns. It's okay. Obviously, if they are expecting, if there's an investor who says that they want to take 51% of your company and give you 2 crores, I don't think that's a deal which will work, because then your investor, if they're not themselves running the company, you end up working for them, and then they may or may not run it the way you want. So frankly, that may not work. But if it's 5, 10, 15%, small numbers, do not over negotiate, in my view. Both ways. This goes for the investor as well as the startup entrepreneurs. But this is the first thing you can negotiate. You can negotiate some other terms that, in the future, if you're doing the next round, what rights do these investors get? Can they put in the same money, or do they have a first right of refusal? Means that if you're raising from someone else 10 crores at 50 crore valuation, your current investors will have the first right. If they want to put in the 10 crores, they should put in. These are the terms which investors would typically ask for, and you can choose to negotiate. Third thing is board seat. Typically, board seat means that do they take a board of directors position in your company or not? They may want it, they may not want it. Depends. And you also, if they want it, then whether you want it or not, that's a negotiation point. Handful of things like that, but there's not too much to negotiate beyond a point once investors have shown interest.
Got it. And this brings me to the next one, which is how to value a startup at idea or POC stages to sustainable and profitable stages. How do you value a startup at all these stages that I just talked about?
Yeah. So it's hard. It's hard to value because there is no valuation metric set for early stage companies. You cannot value them because, look, if Uber came to me in 2008, I might have not valued them over 5 crore. But it doesn't matter where I'm valuing it. Whether it's 5 or 10, it doesn't make any difference to me. As long as they can become a 1,000 crore company, it's fine. I'll make money in every way. Problem is, and it rarely happens that whether it's 5 or 10 crore valuation or X crore valuation of the company, Rarely happens that I'll make or lose money because it goes from 5 to 10 or 10 to 15. The way I make money is either it becomes 100 crore or it goes to zero. As far as I'm concerned, there's nothing in between. There's nothing in between will matter as much. So valuations typically early stage are just driven by some thumb rules, how much you are diluting, how much you are looking to raise. Typically in every round you are diluting 10 to 20% of your equity. It's not necessarily driven by your revenues because early stage you don't have fixed recurring guaranteed revenues. They may be ad hoc and once in a while if you have them, etc. One bad way of valuing, some companies come to me and I find it very wrong, is that someone will say that I'm in this business, and in this business in US there's a company who raised 10 million at 100 million valuation. Remember, India is India, US is US. Okay, our economy size is 10 times different, our opportunity size is 100 times different. So what works in America at a valuation will not work in India at similar valuation and may never work in India at all. Okay, so that's not a good matrix that somebody else has raised. I deserve the same valuation. But somewhere I think it should be just an easy, honest conversation. Look, last round you did at X. This is how you can grow the business in the next 1 to 3 years with this money. Next round will be at Y. Between X and Y, let's agree on a number and let's make sure you only dilute 10 to 20% of your equity for the money you are looking to raise. Everything else, whether you apply a discounted cash flow or revenue multiple, any model, financial model, they beyond a point they're all hypothetical. They don't really matter before Series A funded companies. So yeah, so that's how I think I would probably look at some of the valuations.
Sure, sure, Kunal. And in these overwhelming times of COVID-19, what are some of the tips for raising money for startups?
So money raising, as some of you would know, is a hard thing, very hard thing. It's even harder. It's become now 2 to 5 times harder than it was before February 2020. So it's become harder, which means that it'll take you longer. You'll need to talk to many investors, and very few will have really money left with them. Depending on the round of funding you're looking at, remember, this is a big economic reset in the sense that a lot of people are going to lose a lot of money at all levels. Big industrialists are going to go bankrupt, I believe, because of the debt crisis, the liquidity crisis, etc., which is going to come from this economic shutdown. A lot of HNIs have become middle class already due to their portfolio valuations dropping 30-40% in the markets. Real estate is going to drop dramatically. A lot of lower class people, daily wages are being pushed to be below poverty line. So all this is a major economic reset. Not many people are going to have too much spare funds to actually invest in startups at this point. So for the next few months, it's going to be very hard. So one thing is, if you can conserve cash, manage your cash flows from your own business, do that. That's the best thing to do. Survive for a year and try to not burn or lose too much money. But still, if your business model needs that and you have to absolutely raise, then you'll have to work 5 times harder because you'll need to meet a lot of people and see who has the money, who can possibly still invest. And at that point, do not worry too much about negotiation because right now, survival should be your number one goal. But otherwise, it's really hard right now.
Sure, Kunal. Before I jump on to the questions from the audience, which I've already collected a few, some people have asked their questions. So, but before that,
Yeah.
one thing which is left from my list is how does crowdfunding work?
Okay, so crowdfunding is basically an idea where you raise a lot of money, small amounts of money from a lot of people. Okay, so think about raising, let's say, anywhere between 100 rupees to 1 lakh rupees from 1,000 plus people. This is the model of crowdfunding where you can run. So there are online websites uh, in US and UK called Seeders and many others where you can list your project, list your business, list your company and say you are raising, let's say 1 lakh, 1 crore, 100 crores, whatever you're raising. Typically 1 lakh to 5 crores actually, few lakhs to few crores. And then present your business there in a very catchy video, very interesting business plan, short summary, etc., teaser, etc. So from that, people get interested to invest in your business. But this crowdfunding is actually not allowed in India. In India, You cannot go to crowds and raise small capital because the fundraising process is very comprehensive and complex. And if you have to start reporting everyone's 100 rupees investment into your business, it's a very complicated thing. You cannot do it. So frankly, crowdfunding is, for all argument's sake, does not work in India. It's broadly illegal, not allowed, and it's practically impossible to do. Okay, but this works if your project, you can generate some sympathy from UK or US investors. You can list it there and bring the money from there. That may still be possible, but crowdfunding is not allowed, not legal in India. It does not work here.
Got it. I'll jump on the audience questions now. So a bunch of these questions that I have, I'll start with them one by one. And in a sense of the limited time we have, if you can be quick about maybe, sharing your answers in brief, that'll be great. So the first one is from Sahil.
Okay.
Sahil is asking, under what circumstances should a startup look out for funding, and under what circumstances it should not?
So if you can run a business, so remember, if you take startups aside, which have become popular in the last 5, 10, 15 years or so, especially since the growth in e-commerce in India in the last 10, 12 years. If you put this aside, majority of businesses do not raise any funding, okay? They work on cash flows, means that if you start an IT services firm, for example, Infosys never raised any startup money. TCS never raised any money. They just started with a few people, started servicing some clients, started providing them services and charging money for it, and then eventually the cash flow cycle and the business grew. Okay, so the case in which you do not need to raise is if you are able to get client advances. Client advance funding is the best funding. Okay, or client revenues is the best number two funding. So if you have something which you can sell to clients and take money from them and use it to run your business and your manage your costs, that's the best way. So it means you can bootstrap. This is what's called bootstrapping. In this case, you don't need to raise funding. The cases in which you might need to raise are, for example, I also ran a business called uTrade, where we built an enterprise software. The first version of the software does not come out for 3 years. For 3 years, with 20 people, we are just building a software. Okay. Now, in this business, we will need capital. We cannot have people say that we'll give you money 3 years later. Nobody will stay with us. So we had to pay them salaries from day one. So we had to raise money. We invested our own money, etc. So that's a kind of a business in which you need money day one. Or let's say you are in a business like Zomato, whether your business needs it or not, but your competition is raising more than you, right? Swiggy is raising, Amazon has money, Uber Eats has money. You will also need to raise, because if you don't raise, then you will die. That's what happened with Snapdeal versus Flipkart, right? So there are business models in which you will need to raise, because either your competition is raising or that you need to invest into the product and business before it starts generating revenues. These are the cases in which typically you have to raise. Otherwise, if you can bootstrap and manage your cash flows positively from day one, you don't need to raise. And that's a perfect situation in the world, in my view.
Sure. Thank you. Nitin is asking, why don't investors sign NDA while going for a pitch deck submission?
So let me break an idea to you. Let me ask a question for everyone. Think in your mind, and then I'll give you the answer. How many of you think that the idea is a very important part of your business? The idea that you're presenting is everything, and it needs to be unique and very proprietary to you. Okay. The answer, whoever said yes is wrong. Whoever said no is right. Ideas don't mean anything. Ideas, if you are, so number one, you should not be pressing on an NDA at all. Think about this. I can give you 10 ideas right now which will make $1 billion in the next 5 years. You want to do them? I'll send you the link, by the way. I'll put it on the chat later. The idea means nothing. All it comes down to is the execution. Was Facebook the first social network? Was Google the first search engine? Ask yourself. Was Flipkart the first e-commerce website? No. It's not the idea, it's the execution that matters. So if you are scared that you share an idea and somebody will do it, you should not be running a business. I don't think ideas mean anything. I get 10 ideas a day. Feel free to reach out to me any day and I'll give you all the 10 ideas. You can work on them. I can only work on one idea every 5 years. So ideas don't mean much. You don't need an NDA to share your idea. Don't be afraid. Nobody will steal your idea. Okay. Even if they do, what's the harm? They're also building the market for you. You should execute better than them, bring the market they build for you, and grow your business. If they can't, then today or tomorrow your product will be in the market anyways, and then they will copy it if they have to, right? Few months here and there will not make any difference, right? So that's the idea. You don't need an NDA, in my view. If you still want it and your investors are willing to sign, go for it. But most investors will just turn it out and say, you believe in ideas, everything. That's wrong. It's the execution which matters.
Sure, Kunal. Gaurav was asking,
Yeah.
to what extent is funding more of a validation for a startup?
Uh, I don't think you should raise funding for validation. Don't do it because it brings its own strings attached. It's a complicated process. It takes a while. Just for validation, don't do it. But yes, partially, if you need it and somebody puts in, yes, it's partial validation as well. But don't do it solely for validation. Okay, it just means partial validation that yes, there is somebody who has money who believes you can do it, the idea can work, the business can work. That's it. Now, can both of you be wrong? Of course, it's happened many times. Many funded companies go down. Look at WeWork, right? SoftBank, WeWork guy, they ran it for I don't know how many years, but to many people, including me, it seemed always long.
Sure, sure. Sanjay had a question. What's the best way to shortlist potential investors best suited for your type of product?
So go to Google search, go to LinkedIn, figure out the best companies in that market you are in or you want to get in. Look out for the influencers in that market or the market leaders or the most visionary people in the segment you are trying to get in and try to bring them on and pitch the idea. Even if sometimes you reach out to them and then connect with them coldly or ideally through a qualified introduction. And sometimes, even if they don't put in the money, they may or may not have the money at the time to invest. But sometimes their validation can help you a lot. They can give you free feedback, which can be very, very useful in you for adapting your idea and adapting your sales pitch and investor pitch, as well as sometimes they are the right mentors and board members you need. So find out in the industry you are in who are the visionaries, who are the leaders, who are the. But remember, these days I think it's a very narcissist world. Everyone is a self-promoted expert and enthusiast and enabler and visionary and Forbes 30 under 30, etc. I mean, all due respect to everyone, I think it's become more of a ego satisfaction thing than actually people having the vision that they deserve. So be careful in picking the people to whom you look up to for your industry and business and to whom you try to bring in as angel investors. The good people, the genuine experts will never have to put that they are an expert in their LinkedIn profile or anywhere else. Elon Musk will never say I'm an expert in anything, right?
Yeah,
Bill Gates will never say that either. So, but some wannabes would. So be careful.
sure, sure. Soumya's question is, what happens during the due diligence process by the angel investors? What metrics would you consider important once the business model is analyzed?
So in due diligence, look, at the time of pitching to angel investors, you would have told them in your presentation and verb otherwise that they do let's say 1 crore of business, they have 20 employees, they have a company formed since 2 years, you have equity which is 50% with you, 50% with someone else, etc., etc. So they will as a due diligence process, they will appoint some accounting firm or an auditing firm, and they will ask them to check everything. So they will go into your compliance records. They will see if you are filing taxes, if you are profit, what is the balance sheet you filed with ROC. If you say you have 20 people, then are you registered with EPF, which is a provident fund? Are you paying every month there? Are you paying GST in advance or timely? Are you, so these kind of compliances are typically checked. Business model is a theory, right? I mean, what you have done till today is what an auditor can find, whether what you say is what you have from your tally records or from the compliance records. But what it will do in the future, that's a leap of faith. No auditor can check that, right? That's only something an angel investor himself has to evaluate or a VC firm have to evaluate that do they really believe that this market is, let's say, 1,000 crores and you will make 100 crores in 5 years. So that's something which is a leap of faith, which People have to decide based on their own gut feels and the conviction they get from you, from the entrepreneur. But other than that, they will only check what you've stated so far from the compliance records. That's a typical due diligence process for which they will reach out to your CA, your auditor, your records, your uh, tele balance sheets, etc., and match them with the appropriate compliances with the relevant authorities across ROC, MCA, income tax, provident fund, etc., etc. And they will ask for bank statements too, just to check that you are running it very cleanly and it's all the white money and there's no cash transactions, etc.
Got it. And an extension to this one is from Mr. I.S. Kakkad, who's asking what could be the shortcomings in a venture which would restrict a VC to invest in a venture?
What are the shortcomings? So typically, why do VCs not invest? So, just to give you an example, a typical VC firm, let's name some like Excel, Matrix, Sequoia, IDG Ventures, Chirate, that have become Lightbox, uh, Lightspeed, etc. All these venture firms typically would get, in my view, at least hundreds of pitches every month. And you know how many they will invest in every month? Probably only one or two, depending on their fund size. Okay, let that sink in. So they will look at hundreds of them. Now, what do they want to see? Number one, they want to see that the market you're going in is a growing market. Can it grow a lot? This is, by the way, similar thing what angels like us would look at as well. Is it a growing market? Yes, number one. For example, today, if you're going in telecom market, it's not growing, it's shrinking. All the telecom companies, many have been shut out. Vodafone Idea are the last one standing. They will also shut out. It will eventually be Geo, the biggest, and Airtel maybe playing some role. It's not a growth market. Okay. E-commerce, it's not a massively growth market. It's a very slow growth market. The big growth markets for the next decades would be esports, virtual work from home, like Zoom kind of models, online customized learnings, healthcare, telemedicine, etc. So these are the growth markets. Number one, they'll check, are you in a growth market? Number two, they will check how good you are as a team, how strong you are. Like it or not, fortunately or unfortunately, the way they measure this, there's no way they can evaluate your capabilities in an hour. But if you've gone to IIT or IIMs or you have one of the co-founders who's done it or some A grade or good schools, somehow that's a benchmark they use. I think there were some statistics I read that 70% funded companies have co-founders from IITs or IIMs. So unfortunate it might be, but that's how they possibly validate. That's a validation for them, which is quick and easy. FYI, so do try to bring in somebody from those colleges, even if they're not too good or just for the namesake. Don't tell them I told you this. So number two thing, they'll look at the team. Number three, they'll also look at the market landscape. Who else is playing in the market? Are you going to compete with Paytm? Are you going to compete with Flipkart? Or are you going be on your own, and there are not too many big players in it yet. You're not going to compete with Amazons or Googles of the world yet. So accordingly, they'll figure out whether you can execute or not. Last thing, they look at your business model and your execution plan and how well they believe you can do it. So again, there you need to come across as very passionate. You know it all. You have some good traction, and you have thought through many things. And some things you don't know, you don't know. That's okay. By the way, it's never a contest to know everything in an investor pitch. If you don't know certain things, just say, I don't know, I'll look in and get back, right? I'm happy to learn as well. So these are some of the things they'll look at. And if your market is not growing, if you don't have a great team, if you are competing with massively big players, etc., or if you have a lot of regulatory dependencies as well, let's say you need a regulatory license, that may be a positive or a negative as well, could be a hurdle. Or if they don't think your execution plan and business model can work, they will say no. So essentially, it's a no for most people, for the most part, until it's a yes.
Sure, sure. I'll skip some of the repeated questions because they've been already answered directly or indirectly, through rest of the questions which I've heard so far. Now, one question I think which is very important from an investor's perspective has come on the screen now. Which it says, if a startup's valuation goes to 5 times in the subsequent rounds, then will the valuation of my investment will also be 5 times? I mean, this is a very relevant question if you look at the exit
Yeah,
scenarios happening here and there.
yeah,
So if you could answer this.
yeah, yeah. Sure. So let's say we invest in a company from Chandigarh Angels Network. We did actually. We invested at about 10 crore valuation and we put in about a crore. Okay. In the next round, they raised another round, I think, and I'm making some numbers up. They might be off, and I'm not going to mention the company, but uh, they 2 years later they raised about 12 crores at 100 crore valuation. Means the valuation has gone from 10 crores to 100 crores. So yes, arguably your investment value, which was 1 crore day one, has now become 10 crores. It has gone up 10 times. Yes, this is what it means. Though it doesn't mean that in many times it happens that in companies your valuation goes up, but you are never given an exit. Means that it's not that you can withdraw it. It's just a paper money. It's a paper valuation. It may go up to 100 crores and it may drop to 50 crores as well the year after. Who knows? Many times it happens in many startups. It has happened that the 1 crore valuation has become 100 crores at some point, at least on the paper, because the company raised that much money at some valuation, but then it drops back to one or zero. This has happened. So there's a movie called startup.com from 1998. A company rose from zero to $1 billion valuation. The guy is shaking hand with Bill Clinton. A year later, it shut down. They go to zero. Within 3 years, zero to billion to zero. So obviously, all their investors' valuation would have grown from zero to X to Y to back to zero. That happens too. So it doesn't mean you can exit it easily. So like Paytm, for example, Paytm has grown from, I believe, close to a few $1 million valuation to now 20 billion where they were valued last. But I guarantee there's nobody getting an exit anywhere. Nobody got an exit because there's nobody willing to buy their shares. This is a very offline private investment. It's not listed on stock exchange. It's not something you can easily exit. So essentially, paper money, yes, valuation is up from if somebody put in money at billion and now it's 20, the valuation has gone to 20 times. Yes, their money is grown 20 times, but that's only in theory, but they can't exit it. It's like real estate. If you have a 10 lakh flat or a 1 crore house and it goes to 10 crores, but you can't sell it, means fine, there's a market valuation, but nobody's willing to buy. That's the same thing here.
Sure, sure. In a sense of the limited time we have, I'm going to ask you some two, three very quick questions. So,
Okay.
Professor Anil Mittal had asked the difference between VC and private equity. If you could briefly touch upon that, and
Sure.
whether
Sure.
whether there
So,
are other sources of raising funding than equity. Whether there are some sources like raising a loan by
yeah.
not diluting equity.
Yeah. Yes. Yes. Okay. Okay. So, firstly, VC versus private equity. Venture capital firms typically invest in early growth stage startups. Startups are typically 5 year old, 2 year old, maximum 10-year old, okay, or not too much older than that. So, and VC capital typically per investment per company is anywhere ranging between, let's say, five crores to 100 crores on as an average. Okay. Private equity typically invest in existing businesses, which are not startups by any means. So they will invest in businesses who are doing hundreds of crores of revenue per year. Valuation might be hundreds to thousands of crores, and their minimum investment size is 100 crores only. So wherever the VC money ends, that's where the minimums of private equity start. So private equity may invest in, let's say, Fortis business or PVR or Reliance Industries or something like that. They'll invest in very, very big businesses, hundreds of crores of money, whereas VCs invest in 5 to 100 crores typically across a handful of startups. Okay, so more early stage, private equities, more mature stage, the businesses would have lasted for at least 10, 20 years before private investments typically come in. So that's a broad difference. It's just like a difference between a small branch of a bank versus a massive bank's branch in Bombay or something. They'll be doing 1 crore versus 1,000 crores of business. So that's how one way to look at it. Second question, any other way other than equity for raising funding? Yes. So you can look at loans. You can look at grants as well. So these days, governments have launched a lot of startup funding grants, Atal Incubation Center grants, etc., etc. There are some bank loan schemes where banks are meant to help startups and give them some uncollateralized, means that you don't have to give any house or any asset behind, and you can take a loan of small amounts like 5, 10, 20 lakhs. The banks, all the branches, all the banks are mandated by the central government to give out some loans. So there are some policies you should Google up. These are typically the loan kind of things you can look at. Otherwise, friends, family is the other thing, where if you have rich friends or rich family, then that's the other way to raise money. These are some of the other ways besides equity and professional investors from where you can look to raise money.
Sure, Kunal. The list is still not exhausted, but unfortunately, in view of the time that we have
Yeah,
actually run out of, we would want to take up some of these
yeah,
questions in the next round of discussion. We'll have maybe next Friday. So, thank you very much for being
yeah,
on Startup Masterclass today, and thank you very much everybody who joined in
yeah.
and took their valuable time out for this. Thank you very much once again, and please stay connected through our
Vineet,
social
Vineet,
media.
Vineet, Vineet,
Yeah,
Vineet, I have one point to add.
yeah,
So, guys, hoping you found some value in the session. You found it useful. We'll keep doing more of these. At least once a week is what we're doing. But if there is enough demand, lots of questions, we'll try to do it twice a week as well from next week. But please keep sending your information. I want to also request you to do one thing. If any of you have any specific questions which you want answered beyond the webinar, they may be a bit more personal to your business, etc. So we can find some 15 to 30 minutes per startup of sort of mentoring or validation or feedback or specific issues where you are stuck, and give our 2 cents on that if you think that's of interest. But you need to earn it. There is no free lunch. The way to do it is the following. There's an exercise I'm suggesting to you, and I'll put it in the chat window as well. There is a Twitter and LinkedIn handle of Chandigarh Angels Network. You can find it. I think I'll ask Vineet to post it here, Chandigarh Angels Network. And there is one for me if you want to interact with me, Chandigarh Angels Network, and Kunal Nandwani is my name. Feel free to follow us and put something on Twitter in the next 1 hour by 6 p.m. where you can do one of three things: either mention a very interesting specific question you have, or mention some feedback on the session or whatever you liked or disliked or anything, or thirdly, uh, highlight a point which you found really illuminating for you, which you want the world to know. Feel free to tag both Chandigarh Angels Network and me and ask your question, give your feedback, or specific highlight a point. The top three, which we select later, Vineet or I will reach out and we will connect offline and set up 15 to 30 minutes of time in the next week during the week where you can choose to ask specific questions that you have. So, in a competitive world, let's make it a competition if that's okay. Though we can obviously give time to others as well. It's not that we don't. We will find time. That's all we have these days, actually. So feel free to do this exercise. Follow. I'll give my Twitter handle here as well, and Vineet has already given the Chandigarh Angels Network. Feel free to connect, do add, and then tag and make whatever statement you want to make. Okay. So Vineet, I hope that's okay. I've
yeah,
just
yeah.
come up with this. I thought it's the right thing to do. Maybe engage
Absolutely,
them a bit more.
absolutely.
Okay.
Thank you, Kunal. That's
and
really kind of you.
and lastly, we will share the links later. Feel free to the audio recording should be published somewhere online. Feel free to send it to your friends who may be interested but could not attend. If you think they can learn something from the session, feel free to share. Sharing is caring. That's all we can do right now. So please do that. So Vineet, that's it from me. Sorry for interrupting.
Not a problem. Thank you very much, Kunal. Thanks a lot for
Okay.
extending your support.
Thanks, guys.
Thank
Thank
you
you.
very much, everybody. Thank you.
Thanks. 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 Bye.